My name is Rodman Schley. As a real estate expert, I've invested millions of dollars in vacation properties all around the world, and I've been involved in the valuation of billions of dollars of properties. I want to share my 35 years of experience along with vacation home investment tips from the top minds in the short-term vacation rental industry. Now, let's do the work. Hey everybody, and welcome to the Vacation Property Secrets Podcast. I'm your host, Rodman Schley, and today you are going to love our guest because he's going to enlighten us on how we can save money with our real estate investments. Dan Nicholson is a serial entrepreneur, and he's a best-selling author who's been a key figure in the real estate industry for over 20 years. As the founder of Nth Degree CPAs and a renowned keynote speaker at events like Collective Genius, Dan leverages his extensive experience to help clients use real estate as a lead tax strategy to reduce their taxes. Dan, thanks for coming on the show.
Yeah, super excited to be here.
Yeah, I want to start a little bit by talking about your background. I know we've got a lot of entrepreneurs out there, in particular a lot of real estate entrepreneurs, and you've got a lot of relevance and a lot of good information. But tell me a little bit about your background.
Yeah, I've always sort of been the guy scheming on business ideas. I mean, as far back as a little kid, I was trying to convince my parents of different things that I could do to generate money. So it's always just been part of my personality. Went to business school, got an accounting degree and an information systems degree, thinking, okay, that's going to be the best combination to be an entrepreneur. And then I went as far away from entrepreneurship as you can go, at least most people would think that, which is I did a fellowship at the board that writes all the accounting standards for 80,000+ state and local governments that are in the U.S. And they're the sister organization to the board that writes all the accounting standards for all the publicly traded companies. And so that put me on a whole different path for a number of years before I kind of woke up and said, what am I doing? Excuse me. I'm really far away from this whole entrepreneurship vision that I had for myself. I was doing stuff on the side, got a real estate broker's license, then a managing real estate broker's license to kind of do my own deals. But finally realized, about 15 years ago that there was an opportunity to do something different in the accounting space for entrepreneurs and real estate investors. So that was finally what kind of gave me permission to leave the corporate gig and stop being miserable because I wasn't designed for that space and start kind of pursuing my own endeavors.
I think you and I would have hung out as kids, but we would have each been trying to get each other to work for one another. It's probably what we would have been doing. But, well, that's cool. So you found entrepreneurship, as a lot of people do. And it usually comes at the point where people don't feel like they're aligned with what they want to be doing in life. They're getting up and doing that work they don't want to do. And they've got entrepreneurship in their soul and in their spirit. So you found that, and you found that in real estate too. I want to talk a little bit today about your background. A lot of real estate investors don't really think about taxes when they start to invest, especially early on. As you get to be a seasoned investor, you get a lot more knowledgeable about the tax benefits and such that come in investing with real estate. But I want to talk specifically with you today about the different advantages that there are out there for real estate investors. And so maybe you can talk a little bit about the top tax breaks, if you will, that people can look forward to.
Yeah, well, if it's okay with you, I'll give a little bit of foreshadowing. So I have a methodology that I call the 4 levels of tax planning. And the idea is based off my observations. So my previous life before I became a full-time entrepreneur was really serving the billionaires and the big, huge corporations like Microsoft. And those organizations and the sophisticated investors, they have what I call an architect, someone who is constantly looking at the overarching changes to the tax code, and they're working with the business, or they're part of the team to show the business or the investors how they can modify their behavior to take advantage of the new incentives. That's what all the sophisticated investors, big corporations are doing. Most small business owners, they have what I call an archaeologist. They just dig up the past. So they say this year's taxes, they're talking about last year. So it's a complete 180 of what the sophisticated investors, big corporations are doing and the average small business owner. So we've got to shift from the archaeologist approach to the architect, and we do it through what I call the 4 levels of tax planning. Level 1, stuff you already qualify for, someone hasn't told you about it. Level 2, small adjustments you can make to either increase the deductibility of a strategy or make something tax deductible. Level 3, home run strategies, things that can reduce our taxes by 30 to 100%. Level 4, structures where future income is not taxable. So I mentioned all of that to say that real estate is a level 3 strategy, what I consider to be a home run strategy. These are the strategies, again, that can reduce your tax liability by 30 to 100%. So pretty cool opportunity, especially because so many business owners want another stream of revenue or a passive income stream of revenue. So I'll pause there and then I can get into more specifics in case you had a follow-up.
Yeah, no, I was just thinking through now as an individual, you're talking about these big corporate structures and such who have always utilized these sources, but private investors or even the small guy can utilize a lot of these same tax codes, correct?
You're exactly right. So there's this misnomer that these credits strategies are only available to the big corporations. And that's not true. The difference is the corporation is always future focused. How do I access these? And they have the resources to do that. The small business owner, the individual investor is usually thinking about taxes last, or they're highly reactive. So they're always living in the past. So we've got to shift our entire kind of methodology.
Yeah, so let's do some teaching today, because I can imagine a lot of people out there are sitting there thinking, well, I would love to be able to take advantage of these different structures and the different ways of reducing my tax liability, but I have no idea where to start. How would you suggest, or what kind of things should they look for when they're getting into investing in real estate in terms of the tax structures?
Yeah, so under the current tax code, we can utilize losses from real estate or a business, and I'll talk about why I mentioned a business here in a moment, real estate or a business to offset 100% of any other business income. So we can reduce all of our pass-through business income to zero, plus an additional $500,000 in income from anything else, like wages, interest income, stock gains, etc. So all business income can be reduced to zero, plus another $500,000 if you're married, $250,000 if you're single. So pretty significant. Now I mentioned losses. How do we get those losses? Well, we don't want to go out and buy properties that don't cash flow. But the way we generate these losses are on paper, if you've ever heard that term. These are on paper losses, which just means that there's kind of accounting and tax maneuvers that we're taking. The primary mechanism is something called accelerated depreciation. And that's just the idea that we purchase a property, let's just say it's for $1 million. By default, we're going to have to take that $1 million purchase price over several years. 27 and a half years if it's residential, 39 years if it's commercial. So a really long period of time. But there's something called a cost segregation study that allows us to accelerate a portion of that purchase price into the current year. So let's just say we get a study done, every property is different, and it says we can take 20% now. $1 million property, we now have a 20%, $200,000 write-off that we're showing on our tax return. So even though it might have been cash flow positive, when we add this $200,000 expense, it now shows a loss. And now the question is, can we take that loss against our other income?
So in a situation like that, Dan, I might go in, and that's for the short-lived items, correct? So I'll go in and we might look at the water heaters or the furnaces, and that's kind of the cost segregation, those short-lived items. Is that what they look at in the segregation?
Yeah, it's a very literal name, as we like to do in the accounting space. The idea is that one property is composed of many different assets. You got the HVAC, roof, walls, windows. And so this study takes the purchase price and allocates it into these different buckets. Some of those buckets have a shorter, under the tax code, life. 5 years, 7 years, 15 years. And the tax code will often allow for those shorter lived 5, 7, 15 year to accelerate it even further and take it all in the first year. So that's how we can end up with 15 to 30%, sometimes more than that, in first year depreciation and create that big loss.
So if I buy, say, a short-term vacation property, and I go and I have a cost segregation study done, that's when I can go in and do that first year depreciation write-off. When does that come back? Does that come back to me at the sale? So am I really kind of more or less just deferring that to the end of the sale?
Yeah, it's a really good question. So let's go back and kind of work through this example. You're about to buy $1 million property. Now, what I'm going to tell all my clients is before you buy the property, let's get an estimate done of what the depreciation is. And all the cost segregation firms that we work with, they'll give you a free initial estimate. So you know the tax savings going in. And that's really helpful because you might be bidding on $2 million properties and one of them has 30% first year depreciation, other has 20%. We want the 30%, right? So we get that estimate done. We claim it on the return. Now there's some other mechanisms to make sure you're allowed to use the loss. If we took 30%, so $300,000, we bought $1 million property, our cost basis is now $700,000. So $1 million, we have to reduce it by the depreciation amount. So if we were to then sell it for $1.2 million, for tax purposes, we'd have a $500,000 gain. The $300,000 piece is from the depreciation that we claimed. That's called depreciation recapture. It's going to be taxed at 25% when we sell it. And then the remaining $200,000, the excess above the depreciation, is going to be at the long-term rates, which typically be 20% in this scenario. So that all happens, to answer your specific question, that all happens at the time of the sale, unless you did something else creative like a 1031 exchange or something else where we're deferring the gain into the future.
So it's kind of just a methodology to kick the can down the road a little bit in terms of when you have to pay the gain. And then, like you said, if you do a 1031, then it really kind of takes it down the road a little bit further. So it's tax deferred, which is still very advantageous to an investor.
Yeah, I think there's a couple components there just to kind of deconstruct what you just shared. First off, you may be in, a lot of my clients are in, say, the essentially 40% tax rate. So even if I do the depreciation this year and then sell it next year and have to pay 25%, if I saved 40% and then pay 25% the next year, I'm 15 percentage points better off. So the what's called ordinary income tax rates might be higher than the depreciation recapture. So you're kind of better off from a total tax perspective. The second piece, and this is kind of the underpinnings of finance, is this whole concept of the time value of money and the idea that $1 today is worth more than $1 tomorrow. Now, never has that been, or we're in a period over the last couple of years where that's been extraordinarily true if you just think about inflation. So the easiest way to understand the concept, something that we bought a week ago costs more today, right? That's the idea of time value of money. Costs keep going up, or we could get a return elsewhere. So even if I paid the same total tax, I paid 25% this year, and then a year from, or I saved 25% today, and a year later I got to pay 25%, I still had a year of purchasing power on that money and potentially a return on investment I could have yield on the money I would have otherwise paid to the government.
That makes a lot of sense. You also mentioned the 1031 exchange, and I know that is something that a lot of people hear about, but very few people really understand the 1031 exchange, especially new investors. Seasoned investors, yeah, they probably have done a lot of 1031 exchanges and such, but can you tell us a little bit about the details on how a 1031 exchange works?
Yeah, so the idea is that we are exchanging one property for one or several additional properties. So it doesn't have to be one for one. It really just applies for investment properties. So your personal residence is a whole other thing. So these are investment properties. We sell it. The money goes into an escrow account. So we don't receive the cash. Then we identify one or a few other properties, and then ultimately take those funds that we received in the sale and exchange it for another property, or again, properties. I mention that because a lot of times you might have an investment with a bunch of equity tied up, and it's better to split it into a couple of new properties. But ultimately what we're doing is deferring that gain. So rather than recognizing a taxable gain when we sell the property, we are rolling it into a new property or properties and kind of kicking the can down the road. Again, time value of money, I want to defer paying tax as long as possible so I can keep acquiring assets that generate a return for me.
And then how long do I have? So I sell my property. I know a lot of people talk about that time window in terms of when do I have to get that property or that money reinvested into some property. What is that window like?
Yeah, it's a good question, and you're right. So once you exchange the property, it again has to go into an escrow account. That kicks off this window of time where you have to identify a property and complete the transaction. And so essentially you've got 180 days. So you have a 45-day identification period to identify a new property. And then I think it's 180 days that you have to finalize that transaction. If you don't, then the transaction becomes taxable. Or if anytime you take out some of the cash, any of the cash portion that you receive would be taxable at that point.
And what about the criteria in terms of, so if I have a short-term vacation rental property and I sell my property and I'm going to go out and buy a couple more opportunities, does it have to be the same opportunity? Do I have to go to another short-term vacation rental, or could I put into an industrial building? Could I do an office building, or does it have to be a similar type of property?
Yeah, so it still has to be in the range of real estate. So, and it needs, if it was a business asset, we have to exchange it for a business asset. We can't go from a rental property into another business. It's got to be as like as possible. So technically 1031, the rule is like kind exchange. So we're looking for a like kind asset to convert it into.
Yeah, that makes a lot of sense. So what about then, we've got, so I've got a private equity fund that does short-term vacation rentals. And with that fund, like if somebody sells a piece of property, they cannot do a 1031 into our fund, even though it handles real estate. What are the rules around that?
Yeah, it's a good question, because in that case, they're exchanging it from a investment in real estate to an investment in a partnership that happens to have an investment in real estate. So that's sort of the nuances that technically they exchange it for a partnership interest rather than a direct interest into real estate. That's what disqualifies it. Does that make sense?
Yeah, so they're kind of, like you said, you couldn't go from a piece of real estate into a business per se. And is that kind of the same thing?
Exactly. Yep.
Okay. Oh, so we've talked a little bit about depreciation. We've talked about the 1031 exchange. What other tax advantages are at the top of your list for investors?
Yeah. A year ago, I did a keynote. Around this time, I did a keynote. So one of the, if not the largest real estate masterminds, about 300 people there. And they're doing hundreds of millions to billions of dollars a year in transactions. And I said, how many in this room are familiar with partial disposition rules? Like there were 2 or 3 people who raised their hand. I'm familiar with this. And these are people who are doing huge deals. And that's just back to kind of this paradigm that exists where most people are with an archaeologist CPA, so focused on the past. A new rule to a lot of CPAs is something that came out in the last decade. To me, a new rule is something that came out right now. It's applicable to this specific tax year. So several years back, this concept of partial dispositions came about, and it's connected to the whole idea of cost segregation studies. So cost segregation studies, again, it's this idea that one piece of property is composed of several different assets. So when you do significant improvements to a property, you are disposing of an asset. So let's go to the idea of a roof. Well, the roof has a cost basis. So you paid $1 million, but we might have assigned $50,000 to a roof. So your kind of investment in a roof is $50,000. When you rip that roof off, you disposed of an asset. You no longer own that roof. So if your cost basis was $50,000 and you sold it for $0 because no one bought it from you, it went to a dump or recycling, right? You paid $50,000, you received $0, you have a $50,000 loss that you're allowed to take on your return. So anytime there are material improvements to a home, there's an opportunity to kind of, in a way, double up. You take the partial disposition on the assets that you got rid of, and then on the new roof or the new room that you built, we're going to accelerate the depreciation on those new assets, if assuming they qualify. So the ideal process actually is you buy a property. If you know you're going to do any improvements, well, you work with a cost segregation company that understands this. You tell, here's the improvements that we're going to make. They identify all those when they come out for the cost segregation study. They do the study, then they come back when the improvements are done. And so the actual report they give you is the accelerated depreciation plus all of the losses from the disposition of those assets. Now, you may not do it in the first year. Any year in the future where you make improvements, we want to grab those partial disposition losses. The amount of thank yous that I've received from also people who are running funds maybe similar to yours, where they didn't know about this, and now all of a sudden they're able to pass on losses to their clients that they're allowed to take as well. So partial dispositions don't have the same real estate professional rules or material participation rules to be able to take those losses because you've disposed of an asset. So you generally recognize a loss for sure when you've disposed of that asset.
Hey, everybody. I hope you're enjoying this episode of the Vacation Property Seekers podcast. I want to let you know about one question that I get all the time, and that's how do I forecast my cash flow and my profitability when investing in a vacation home? Now, if you've ever wondered that or you know somebody who has, you're in the right place. We've created a free training called Financial Forecasting for Maximum Vacation Home Profitability. Now, in this training, we're going to guide you step by step on how to accurately project rental income, estimate your operating expenses, and calculate your returns so you can make informed investment decisions. You can access the free training at vacationpropertysecrets.com. So if you're ready to dive deeper into financial fundamentals and maximize your profitability, visit vacationpropertysecrets.com. So sitting here as an investor, and I can only imagine what the people sitting on the other side of this mic are thinking or hearing. And the question that would come up in my mind is, number one, how long does it take to do a cost segregation study? And then what kind of costs are involved with that?
Yeah, so good news on a cost segregation study. It doesn't have to be done right away. It just needs to be done before you file that year's tax return. Or if you've missed it, because you're at the last 3 returns I've looked at for new clients that have real estate, they were showing profit on properties that they just purchased because they weren't claiming depreciation. And that's always a red flag for me. The point is for us to create losses, and you're reporting taxable income. This is an easy fix. So if you miss it in the first year, you can do it in subsequent years and catch it up. But it just needs to be done before you file the return. Typically, cost segregation firms are scheduling a couple weeks out to a month out. So you want to plan at least 2 to 4 weeks of buffer for them to come out. They will have given you an estimate beforehand, so you already have a general idea of it. And the turnaround time is usually about a week from my experience, from the folks we're working with, from the time they go out to when they finalize the report. So all in 4 to 5 weeks of time frame that you have. Cost ranges from a couple $1,000s to $4,000 or $5,000, depending on the size of the property and the location of the property. But costs have gone down a little bit in recent years, just with some technology that these companies are able to use to get the studies done.
That makes a lot of sense. It sounds a lot like kind of the timeline and the cost is maybe a commercial type appraisal almost, in terms of what people can expect and timelines and such. So we've talked, okay, that's that. So far, we're knocking it out of the park. I think this is going to be very valuable for people to hear. Again, most people don't think about these things, particularly those new investors who are maybe even buying their first short-term vacation home or their first investment. They don't really understand that they've got these things available to them. Are there any other tax laws that they should know about right out of the gates?
Well, because you mentioned vacation home, one of my favorite or highest leverage strategy is when you can fund a goal that you have through tax savings. So say that you want a vacation property, but you haven't thought that you could afford it up to this point. Well, if you use it as a short-term rental, at least for the first year, and you don't exceed the personal usage rules, which is can't use it more than 14 days or 10% of the available rental days. So as long as you don't exceed that, you're allowed to take losses. So you can take advantage of the short-term rental rules to get tax savings to fund a significant portion of your down payment to acquire maybe a second home that you want to use. And so after a year or two, you could decide to no longer have it as a short-term rental, but you still got the tax benefit. So I do like to call out to folks that they can use the tax code as an incentive to fund a goal that they have already. But secondary to that, as you build your portfolio, you get some additional kinds of what I call economies of scale. So at some point, somewhere between 5 and 10 doors, could make sense for you to add in a management company, typically a C corporation. That management company charges a fee, 8 to 12%, back to the properties. That's going to be an additional expense and might create an additional loss. That goes into your management company, and then you use that to pay out certain benefits. So you might use it to pay out to form something called a health reimbursement account to reimburse you for out-of-pocket medical expenses. You could use that C Corp if you didn't have other entities to set up a tax-deferred retirement accounts like 401ks, SEP IRAs. You could utilize it to pay out something called the Augusta loophole to pay your kids. So if you'd already have a business entity vehicle, you can use this management company to create some additional deductions and strategies that are all getting cash and benefits back to you. The end goal is for that C corporation to essentially show no profit or loss. It's going to take all the cash it receives and then offset it with paying it out to various tax strategies that we've kind of mapped out.
And at that point, you've taken full advantage of the tax codes. I mean, right. I know that a lot of times people go, well, I feel like I'm cheating, but you're not cheating. You're literally just taking advantage of the tax codes that are in place to better your situation in building your own personal wealth.
I think that's a really important point because it can make some people feel a little bit uneasy. Like, how is the IRS going to come hunt me down? And of course, there's a narrative that the IRS is like this big bad wolf that wants to put you in jail, and that works to their benefit to keep people in compliance. But our approach is not to speculate on what you're allowed to do. So I joke that most CPAs are like a double agent for the IRS, where they're telling you what you can't do and using a lot of fear. And I don't know, we got to pay the right amount. And they're deciding your risk tolerance for you based off what they feel comfortable doing. If they were an investment advisor, they'd be in huge trouble for that, because as an investment advisor, you'd have a fiduciary responsibility to find out your client's risk tolerance and build them a portfolio based off that risk tolerance. What we do is a different approach, which is more finding a client's risk tolerance. But we aren't guessing, we aren't speculating, and we don't have to guess or speculate because, and I get a little bit granular about this for a second, the way it's important to understand the way the tax code actually works. Congress writes it. The IRS has been given the authority to enforce it through the Department of Treasury. But the IRS does not write the tax code. They just interpret it and enforce it. And the reason why that's important is some taxpayers disagree with the IRS's position and they go to tax court. Now, my clients don't usually want to do that, but we love those people who go to tax court because that all becomes public record. And so we know what is authoritative. So that's going to be the most authoritative guidance, is the tax court cases. So when we're talking about these management companies and the Augusta loophole, or utilizing cost segregation studies, all these sort of things, we are going to what the court cases say we're allowed to do, and we're copying what the documentation requirements are. So we're completely in compliance with what the court cases say, and then we're looking at the IRS audit manuals, what they produce as public information, to see how they're going to audit those strategies, and then we're mirroring the documentation that the IRS wants as well. So there's no speculation. And for many clients, they end up with less tax and they have less risk because now they're actually conforming to what the rules truly say rather than speculating.
Yeah. So what about if I'm an investor and I'm sitting there thinking through this too? I mean, there's going to be a lot of different people with a lot of different ideas, probably even on the tax code, or different knowledge levels in terms of what they can utilize. if they're looking for somebody to represent them, looking for a CPA and such, what kind of questions should they be asking to make sure that they've got somebody who, number one, is very familiar with the code, that's going to be relevant to what they're doing in terms of real estate investment?
Yeah. So the first thing I like to ask anyone is, what's the most important financial statement? And if they say anything other than the balance sheet, I question their expertise as a CPA, because the balance sheet is the most important financial statement. That's where you see your assets, liabilities, and equity. That's where you see depreciation. The end game is to grow your net worth. That's what we see on the balance sheet. So we're doing all this tax stuff so we have more cash to acquire more assets so we can grow our net worth. That's at least the way I see things. So what's the most important financial statement? Correct answer, the balance sheet. What is your approach to tax planning? Like, do you have a methodology? We use what we developed, the 4 levels of tax planning. That's our own methodology. You can Google it. You're just going to come back to find our approach. But I want to know, do you have a methodology and principles and frameworks, so you're not just making it up client by client? What percentage of your clients do you do ongoing tax planning and support for? Want that to be more than 50%. And then depending if we're talking about real estate specifically, I would ask them something like, can you explain partial dispositions to me? Knowing that most aren't going to know the answer to that. So if they don't know the answer to it, then it's just a signal to you that they're not necessarily staying up to speed on new and evolving rules.
That makes a lot of sense. What about, I'm thinking in terms of wealth building. So many people get into real estate, and I always tell people real estate is one of the best ways to build wealth. It's one of the greatest ways that even people who have not been able to build wealth is primarily because they can't get into real estate. So do you think that that's true? And if so, what would you recommend for people in terms of maybe how should they start getting into, how should they start?
Yeah, the sort of 0 to 1. So first off, I would align with either real estate and or business, things that you have control over, and it's going to be the best way to build wealth. And to sort of go from 0 to 1 is changing your orientation towards building your wealth. So most of us go into things from an effort perspective. Like, and it's a big part of our culture, and I see a lot of value to it, but most people build another job with their real estate portfolio, or they get into business and they create, because they didn't want a job and they create another job. So we have to have from the perspective of not the most amount of effort and the most amount of risk, but how do I build this in a way that's going to require the least amount of effort and the least amount of risk and the least amount of obligation. So having that point of view to me is critical. Now, that's not to say we're going to be lazy. It's just that for a lot of us, hard-charging entrepreneurs, our least amount of effort is still more effort than the average person. But the idea is that if we become too oversubscribed, we have too much on our plate, taking too much risk, then when the killer deal actually comes available, we can't participate. So when I get a call from you and you've got another property you're acquiring, another fund that you're raising, it's like, I can't participate in that, even though it's got more upside than these other deals, because I tied up all my cash in time in something that didn't have a whole lot of what I call asymmetric upside. So building it the right way from the beginning, from that least amount of effort, least amount of risk, and then not doing any deal that you're not willing to be in, for at least 5 years. So in real estate, it's my point of view that if you're willing to be in something for at least 5 years, you're going to win. Now, it doesn't mean you don't end up getting out a lot sooner. It's just that from the beginning, you have to be willing to keep your capital in for 5 years. We go back to 2008. If you got it in 2008 and then you had to get out in a year or two, you felt like an idiot. Mm-hmm. If you could stay in for at least 5 years, you at least look like a genius, or you broke even, depending on the market, right? Sometime around 2013, 2014. So a lot of us end up as exit capital for the people who are actually going to make a bunch of money, because we can't stay in it long term. So change your orientation, less effort, less risk, less obligation. So we can actually get into the killer deal, killer opportunities, and make sure that our duration is at least 5 years so that we can weather whatever economic cycle may confront us.
I tell that to people all the time. Real estate is just a bunch of cycles. And like you said, in 08, 09, when everything hit the fan and the banks had their crisis, I mean, real estate was bargain priced. I mean, everything. You could have picked up so much real estate. And people who are afraid to invest now, I always tell them, it's like, listen, if you could have bought in 08 and 09, where would you be now? If you had $2 million, if you had $3 million, or you had whatever to put into real estate back in 08 and 09, you probably wouldn't have to work anymore, right? And unfortunately, like you said, people have to have that staying power and the ability to go, okay, I'm going to buy now, but we tell our folks to look at an 8 to 10 year hold. And we're going to buy, look at an 8 to 10 year hold, and we'll sell depending on where the market's at that time. Because you don't know where that cycle is going to be. And you can never, of course, just like the stock market, it's almost impossible to come in perfectly in and perfectly out. But at the same time, if you can weather that cycle and be in the right spot in that cycle, you'll do very well.
If we go back to 2008 and we look at the wealth gap between the 1% and the 99%, or the 1% and the 0.1%, and then we fast forward 5 years, we fast forward 8 years, 10 years from the 08, 09, what happened? Well, you know the answer. The wealth gap grew considerably more between the 99 and the 1% and the 1% and the 0.1%. If we go back to 2019, 2020, with COVID, you look at the wealth gap, and then you fast forward to where we are now, the wealth gap grew considerably again, right? And so we're at this junction right now. Rates are high. I was just talking to a client yesterday. I talked to a bunch of banks yesterday and kept hearing, 50% of banks aren't lending right now because of their exposure to treasury bills and their liquidity crunch. And sharing this with the client, he's like, "Well, do you think I should?" He's trying to get a bigger loan to grow his business. He's like, "So you think I should hold off?" Like, well, maybe. Like, I try not to give specific investment advice, but my general macro point of view is that when things get hard, that means there's opportunity around the corner. Most people are going to be getting out. So rates are high. Maybe a pretty opportune time to get some deals because there's less buyers. Refinance later. Get access to capital now. If you think there's some bank crashes around the corner, you got the capital. Bunch of businesses are going to be hurting. You're going to be buying them at a discount. So we keep having these cycles where the 99% are they're exiting, and the 1% or the 0.1% are gobbling up these deals, and they're winning long term. So don't be the exit liquidity.
Yeah, and you don't have to be the 1% to be able to take advantage. Just be smart and have your capital ready to take advantage of those opportunities, because like you said, they're inevitable. The cycle is going to continue and continue and continue. It's just a matter, are you ready for it? Are you ready to capitalize on the cycle?
100%.
Yeah. Dan, I want people, this time has gone really quick. I think you and I could have talked about so much more here today, and there's so much more for people to gain in terms of knowledge from you. So I want people to be able to find you, to get additional information. Where do people need to go to find you?
Yeah, there's two things I want to mention. One, you can find me in the CPA work that we do at Nth Degree CPAs.com. So Nth Degree CPAs. And the second thing I wanted to mention is I recently launched something called the 5 Wealth Types. And I built this assessment. It's 15 questions. It's totally free. And it tells you if you're a hustler, a gambler, an optimizer, a saver, or an outsourcer. And that gives you these recommendations, 4 or 5 things that you should do now based off your wealth type. See, most of us have been told we're a saver or we're a spender, all this sort of all or nothing type thinking. But from my experience working with 2,500 plus business owners, that there's these 5 types, and there's no right or wrong type, but understanding your type. Most of the entrepreneurs are going to be a hustler or a gambler, helps you to design a better system to get you the results that you want. So completely free at wealthtype.com.
You've got me actually wondering now what I am. You said all those, and I said, well, maybe I'm a little bit of all that. So I maybe go take your assessment to find out.
Yeah, right now we just give you the one that's the most prevalent, but you can reach out separately. I can tell you kind of what your secondary score would be.
Oh, that'd be fantastic. And the last thing, again, people sitting there at home, maybe beginners just starting, what's step one for them? Where should they start?
I would tell people that step one is to figure out what I call your solvable problem. And so that's a concept that I realized after going to a bunch of masterminds and talking to a bunch of real estate investors, business owners, that many of us have put together our vision board, and we got a bunch of dopamine when we did it. And we're going to have these 6-pack abs, and we're going to have this second home. We're going to be this great parent and all this sort of stuff. We put all these images up on a board. And then for like 2 weeks, we're getting up earlier. We're doing a bunch of stuff. And then it all kind of fizzles off. And it's because it's not a solvable problem. It doesn't actually tell us the resources necessary to turn those goals or life vision into a reality. And so I have an approach for how you can take that kind of vision board and turn it into a solvable problem, which is really just putting dollar values and dates to each of those goals, and then looking at what your current resources are and calculating how much more do you actually need to make to hit that timeline. Sort of like most of us want to get to Disneyland or Disney World or some outcome. We're putting it into Google Maps, the destination, but we're not giving it our starting point, and we're not telling it the method of transportation. Are we walking? Are we flying? Are we driving? So it can't calculate the most efficient path to get there. That's what we need to do with our life goals, is turn it into a solvable problem. Because for many of your listeners, once they see how much they need to make additionally per year to do that, it might be that if they could invest in real estate, recover all the tax that they're paying, reallocate that, they don't actually need to grow their business anymore because they've unlocked all this tax savings that they've been missing out on that could be reallocated to building a portfolio. And so if you don't know the resources needed, you can't figure out the most efficient path to get there.
I love it. And by the way, when you were doing that analogy, all I could think of was vacation, where they are going to Wally World, getting the transportation and the destination. But that's kind of where we start. I think that's great advice. Dan, I hope people connect with you because I think you're a wealth of knowledge. I want to connect with you more to learn more for myself too. So thanks for coming on the show today.
Yeah, my pleasure. Thanks for having me on. I appreciate it.
Thank you for tuning in to this episode of the Vacation Property Secrets Podcast. If you enjoyed the show, we'd really appreciate it if you could leave a rating and a review on Apple Podcasts or Spotify. By leaving a review, you not only support the show, but you also help others find and enjoy it just like you did. Also, please share this episode with somebody who could benefit from it. And if you're aiming to build a short-term vacation rental investment business that's based on strong investment fundamentals and not just emotion, I'd love to invite you to a free training that I'm hosting. It's my financial forecasting for maximum vacation home profitability training, an on-demand video course that's completely free. It walks you through the investment fundamentals to build and scale your short-term vacation rental business. You'll also learn how to estimate investment income and your operating expenses to build a projected pro forma operating statement and the potential NOI and return on investment for your property. Just go to vacationpropertysecrets.com to get access to your free training. We'll see you next week for another episode of the Vacation Property Secrets Podcast.